We've got a big potential takeover of Fannie Mae and Freddie Mac, an optimistic Lloyd Blankfein, and a big IPO put on ice. You're in the right place, folks, because this is where the money is. Welcome to the show. It is Wednesday. I'm Matt Copenheffer. This year is David Hansen.
You're back.
I am back. And you know what? You know what happened over the weekend while I was gone?
You grew a beard.
No, that's been happening for a while, and it's terrible. That is not the story. The story is that you and I showed down, faced off, whatever you want to say, in fantasy football. And what happened?
I think you won this time. We're 1-1. I'll see you in the championship.
1-1 indeed. All right, I won't make you dwell on that. Let's just get to the headlines. The first headline we have for today is from the Financial Times. The headline is Investors Pitch to Take Over Much of Fannie and Freddie. This is some private equity funds, some hedge funds looking to basically buy Fannie Mae and Freddie Mac, or big parts of Fannie Mae and Freddie Mac, away from the government. We've got Fairholme in on this, Bruce Berkowitz, who's talked a lot about the preferred shares of Fannie Mae and Freddie Mac, Blackstone's GSO arm, Paulson and Company, Perry Capital. They're trying to pull in KKR and Carlyle. This is like
who's who.
Yeah, this is like the titans of Wall Street getting together. Do you think this has any chance of happening?
My first thought was no. Well, my first thought was I had to read the article twice. I was like, so Wall Street's trying to buy Fannie and Freddie? Because yesterday, Morgan and I talked about kind of all the obstacles that are in the way of actually doing anything with them, and that this could draw out for 5 to 10 years. I don't think this is a realistic kind of avenue of where Freddie and Fannie will go. It's possible, but putting all private capital here and buying out the government, this just seems way out of right field. I don't know if this can really work in the long run.
Now here's probably the question that more of our viewers and listeners are wondering about is what happens to the common here? Because as I read over this article, and to be sure, the details here are sketchy so far, but as far as I could tell, it sounds like this is a private equity buyout, and this is done by folks who own a lot of the preferred shares, and I'm kind of thinking that the common may get left out in the cold here. Again, this is early hearing about this, and like you said, I'm probably on the same page as you in terms of this not actually having a chance of happening. But as I've said before, if you put a gun to my head and said you had to buy either the preferred or the common shares of these, I would feel a lot safer being in the preferred, and this may back that up. Just that the preferred shareholders seem to be trying to wield some power here in this situation.
Right, you may not have as much upside as you do with the common, but I think the chances of you being completely wiped out are a lot smaller. Still pretty big in my opinion, but a lot smaller than the common there.
So if this moves forward at all, it'll be very interesting to hear about what would happen to the common, because the preferred in this plan would get converted to common shares. So
very interesting.
We'll have to wait and see.
All right, next headline came from Bloomberg. Blankfein says Goldman Sachs can boost ROE, that's return on equity, without major changes. So before the crisis, Goldman Sachs return on equity between 20-30%, huge. Now it's only around 10%. And Blankfein came out and said, hey, it's 10%, it's lower, but when the risk-free rate is 0, it's not bad. Give us some credit here. So I think you have to be optimistic, as Lloyd is, that he's saying, now's not the best time for our firm, but we're not going to do anything to really change the face of our firm just to try to boost ROE in the short run. He said, we have a good business, we're going to keep doing what we're doing, and over the long run, that should move up just based on where we are in the market.
I think that's a fair approach, and I tend to agree with him. I think it's a really good business. There are knocks that you can make against Goldman Sachs, including the fact that it's a very opaque business. So outside investors don't really have good insight into what's going on behind closed doors at Goldman Sachs. But I do think that there's certainly opportunity to expand ROE without doing anything too crazy. However, the concern is that right now, taking risk right now versus taking risk down the road, when's the payoff better? And over the last few years, there's maybe been more opportunity for safer risk taking, and as the market starts to heat back up, that's maybe the time to get a little bit more concerned about taking too much risk. But I'm going to say that Lloyd Blankfein probably knows a good time to be throttling risk. So hopefully that is the case.
And you say Goldman's an opaque business, and I would probably agree with that. It's not easy to go through their filings and understand everything that they're doing and everything they're invested in. But I will say that Lloyd Blankfein's he's very good at communicating the business and the economics of his business. He's not on the conference calls all the time. He usually leaves that to his lieutenants. But when he's out doing interviews, he is very clear about the business. What do they do for their clients? So as a shareholder, I feel confident with Lloyd steering the ship.
But try to get him to tell you what's going on inside the trading business.
That's their secret there. That's their secret sauce.
That's their whole business.
But I feel confident that he is thinking long term. You can say Goldman Sachs traders, they can be short-term thinkers sometimes. That's possible. But Goldman Sachs, the business, does think long term. So
it's a jockey playing you like Lloyd.
I do indeed.
All right. Third headline here. We've got a fun one. This is from DealBook. Back injury puts football player on IPO delayed list. This is, of course, about the proposed Arian Foster IPO.
Mm-hmm.
This was through a company called Fantex was organizing this, but then Stifel was also going to be the underwriter on this. So I would think, obviously, Fantex and Stifel are potential losers on this.
Mm-hmm.
It was probably not a huge amount of potential income for them, but sort of an innovative IPO, an innovative offering, and maybe something that could have been repeated. So when you look at what's happening with Arian Foster now, whose season's over,
mm-hmm.
and this would really ding the prospect of having this go forward in the future for him in particular.
Right.
So the question is that can they then roll this out to other players or teams or whatever? And I would say people would probably think twice now.
I think they will think that. They should have thought twice in the first place. But it does make sense. And for those who don't know, is Arian Foster the football player? And I think the deal was he would get around $10 million up front for a return of, I think it was 10% of his future earnings, whether it be endorsements,
but it was brand-related endorsements, right?
And contract as well.
Oh, it was contract.
So it was 10% of his future earnings kind of into perpetuity there. And it's kind of a lose-lose for everyone. It's a lose-lose for Fantex. It's a lose-lose for Stifel. It's a lose-lose for Arian Foster because if it would have gone through, he would have got a nice lump sum of $10 million there. He's not getting that anymore. And now his career is maybe a little bit in the balance. And he would have got the $10 million. And the way it was worded is he would have had to stay in the league for 2 more years. Mm-hmm. So if he would have retired within 2 years, then he would have had to give it back. So now he doesn't get the $10 million. He's 27 years old, having back surgery. I'm not a sports analyst here, but
Adrian Peterson with major knee surgery just a couple years ago.
That's true. So it's not a good situation for everyone. But I think it is I don't think it's a model that's going away. I think this probably has a niche market.
How soon before we see a David Hansen IPO?
Oh, there needs to be one. I mean, my future earnings, they're looking bright.
There does need to be one. All right, moving on to the emails for the day, right? Mm-hmm. That is our next stop. You can email us, readers and viewers and listeners can email us at WTMI@fool.com. Question today, Matt has indicated that he is not a fan of AGNC, that's American Capital Agency, ticker symbol AGNC. So what would it take for Matt to become a fan or an investor? That's from Del Clark, an AGNC shareholder. And yes, I have said on a number of occasions that I'm not a big fan of AGNC. What would it take? So part of what it would take is I would want to see a more conservative management team for starters. And they've started to show that, to be fair. They were talking about being more conservative last quarter during the conference call. Mm-hmm. But still, compared to some of the other mortgage REITs that they compete with, that you could compare them to, Annaly has been much more conservative for a longer period of time, trying to manage an uncertain mortgage REIT and bond environment. So that's part of it. I also prefer the idea of some more flexibility within a mortgage REIT. So both American Capital Agency and Annaly Capital, I wouldn't say they're totally restricted to just agency-backed mortgage-backed securities, but primarily that's mm-hmm. basically all that they invest in. And sometimes it'll be a good time to invest in agency mortgage-backed securities. Sometimes it won't. Right now is one of those times when it's not really. So you're seeing the downside to being hitched to just that. So that's part of the problem too. And then I think it would take some of the other mortgage REITs out there to not be as attractive. Because when it comes down to it, even if I started to like American Capital Agency more, at some point you got to make a decision between the choices that are available to you. And I frankly, I think Annaly Capital has it has a longer track record for sure. I think it has a better management team there. There's some knocks you can put against that management team, but I still like it better. And Two Harbors, which is my favorite in the mortgage REIT space, they have a lot of the ingredients that I like. They have a very good management team. They have a lot of that flexibility in terms of where they can allocate capital, and they're looking to turn that business into less of sort of a hedge fund and more of a sustainable business, which I really appreciate.
So where does price come in with AG&C? So it's trading at a discount to book.
That's
maybe,
yeah.
I think, I don't have the numbers in front of me, but maybe a 10 to 15% discount to book now. How cheap would this have to get to for you to be, okay, now I'm interested at a 25% discount to book?
So, but the question would be,
why is it?
At a discount, how much more of a discount than competitors?
Right.
So if you look at Annaly right now, at least last time I checked it, it was about a 10% discount to book value. So if Annaly's at a 10% discount and American Capital Agency is at a 15% discount, I still think I like Annaly better. If Two Harbors, I think Two Harbors may be around the same too, if I'm not mistaken. Definitely prefer that there. If all things held equal to right now, and American Capital Agency maybe had another 10 to 15% discount versus the others, I could consider that might get me more interested.
So amongst its peers, it has to be significantly cheaper for you to even consider.
Yeah, because price is certainly a consideration for me, but it's not the foremost consideration. I mean, you have to consider what the entire business is worth to be able to compare it to that price. And into that consideration of how much is this business worth, it's who's the management team, what's the future of the business, all these kind of factors. And I think those factors are worth more. They're more valuable at other mortgage REITs versus American Capital Agency.
All right. So you're not a fan, but some things that could potentially make you a fan. Potentially.
That could push me in that direction. I also don't have that much interest in overweighting. I actually have no mortgage REITs in my portfolio right now. I don't really have an interest in having a whole bunch of them in there either. So if I bought any for my portfolio, it would probably be one, maybe two.
All right. Well, I'll tell you what. This is what Del should do. Del should email us and say, why does he like American Capital Agency over the competitor? So I'd love to hear what his
or any other viewers and listeners who are interested in the mortgage REIT space. We understand that not all of our listeners and viewers are interested.
Mike has told us that.
Yes, but if you are, let us know your favorite. Let us know why. Let us know why you think we're crazy.
There you go. All right.
Moving on to our game for today, it is Rank It, and we were talking about earlier today. We were talking about Lloyd Blankfein, and saying how he believes that Goldman Sachs can get to a better ROE without doing too much of anything different. Does that put Goldman at the top of your list, or somebody else beat them out?
Right. So we're ranking the investment.
We are. Yes. Sorry. I went through all that. Yes, we're ranking the investment banks.
And pure play investment banks. So we're not including J.P. Morgan, Bank of America. They have investment banks, but we're going to stick to the Wall Street guys.
Because we covered them in when we ranked the Big Four.
Exactly. So to answer your question, here are my rankings, 1 through 5, my favorite investment banks. And Goldman Sachs takes the top position. I'll read them off real quick. Number 1, Goldman Sachs. Number 2, Evercore. Number 3, Morgan Stanley. Number 4, Lazard. And number 5, Greenhill. So Goldman Sachs, we talked about Lloyd Blankfein earlier. I'm not going to rehash all that. I still think it's cheap. I think ROE will improve. I'm a shareholder of Goldman Sachs. Happy shareholder. They're my number 1. Evercore is my number 2, and I think on your rankings you have them a little bit lower, and I'm going to disagree.
Why are you?
I'm getting ahead of myself,
yeah,
but I was upset when I saw you had Evercore ranked lower. The stock's been a big performer, and I think it's justified.
You think that's going to convince me?
Well, no, I'm saying I think you may think it's expensive. The stock's been on a great run. It's outperformed most of these here on the list. And I think it's justified. They're growing business. They're winning business. Yeah. We saw their earnings last quarter. Huge earnings. Stock jumped 9%. And that's not a thing that I love to see since I'm not a shareholder, but I think it's warranted. I think it's a winning business that the market's realizing it's winning. So they are my number 2.
What differentiates that and makes that better for you than a Lazard or a Greenhill?
It's hard to point to the one thing that's a differentiator. I like how they're kind of a pure play on advisory. I know Greenhill is too. But you're kind of like the mortgage REITs, you're betting on the people. You're betting that they get the business, and they're getting the business. So you can't argue with the results. So they're my number 2. We can get back to some of my other ones, but I'll let you read your.
All right, yeah. Let's go ahead and put up my rankings here. Just like you, I've got Goldman Sachs number 1. I've got Morgan Stanley as my number 2, and then it's Greenhill, Lazard,
Evercore in the basement.
Evercore number 5. But look. Here's the other thing to consider. We didn't, although we ended up covering the same companies in our rankings, we didn't have to. So there are other investment banks out there that we could have considered in this, and they did not make the rankings. So Evercore number 5 on my list, but that doesn't mean that they're my least favorite investment bank investment.
Your 5th favorite.
Fifth favorite. There you go. Goldman Sachs. I don't think just my favorite investment bank. I think that is one of the better opportunities out there right now, period. Goldman Sachs at 1 times book value, I think is a great opportunity. Morgan Stanley, it's not Goldman Sachs. It doesn't have nearly the business, I don't think, that Goldman Sachs does. But I think that there is a turnaround going on there that is going to bear fruit. And Morgan Stanley does have a strong franchise. It's not the same kind of franchise, again, as Goldman Sachs or even some of the other, like JP Morgan, same kind of franchise there. But I think it's worth more than where it's trading at right now. So really, that's more of a price-based ranking right there. Greenhill, I think Greenhill is, in terms of the boutique investment banks, my favorite. I think they've got really good people there. They've got a good presence globally. So their U.S. operations are good. I think they have good people everywhere. But they have been winning. They've historically won a ton of business in Europe and elsewhere. And I think particularly as we see Europe start to recover a little bit more, that could help their business. Moving on to Lazard, the same is kind of true there. Lazard also has a very big stronghold in Europe and globally. So U.S. investors may not be as familiar with the Greenhill and the Lazard because they have more of that presence overseas. And you gave enough of a pitch of Evercore. I'm not as big of a fan.
Evercore. I'm
hating on it, but
I know you're not hating. I actually do. I think I like the businesses of these boutiques. I guess they're not really boutiques. They're really just smaller, pure play investment banks. I think I like it. I'm not going to say 100% like the business because they're smaller. How much market share can they get? But I think there is a spot for these smaller pure play investment banks rather than, I know they're competing against Goldman Sachs, JP Morgan, but I think there is a space for Evercore to be that pure play, focus on the client. So long term, they're a little bit hard to judge where these businesses are going to be 10 years. What are the earnings power going to look like 10 years from now? I'm leaning towards that it's going to look brighter than it is today. So I'm fairly optimistic on the industry as a whole.
Do you own any of the, I'm still going to call them boutiques, even if you don't want to. Okay. Do you own any of the boutiques?
I don't, but they're being put on my radar. We've got a lot on our plate here. So I've got a lot of businesses I'm looking at.
You are a Goldman Sachs shareholder.
I am a Goldman Sachs. None of the smaller guys, though. They're on the list to look into and find some opportunities.
There you go. All right, well, let's close it out today with a visit to the Twitter sphere. David, what's the first tweet?
The first tweet is about Mike Mayo, and it's from Arian Luchetti. Luchetti. Is the C a K or is it a ch sound? We can ask him later. The tweet is, analyst Mike Mayo takes on Bank of America's Brian Moynihan, and he links out to a Wall Street Journal article there. Mike Mayo, the polarizing bank analyst, I guess you could call him that.
It's pretty fair.
Called out Jamie Dimon called him out earlier this year. So now Mayo's calling out Bank of America. He rated this stock as a sell in 2012. It's since up 70%, and he's sticking to his bearish points on this. He's saying that since Moynihan took over, stocks lag into KBW by 58 percentage points. Their metrics aren't clear in terms of how they're judging performance. And his quote was, "Don't confuse brains with a bull market." So he's not giving Brian Moynihan and Bank of America a lot of credit. I know he's a smart guy. Do you disagree with any of this?
Well,
I'm assuming you do, since you're a shareholder.
Yes, I do disagree. It's not easily that you disagree with a guy like Mike Mayo. He's a very sharp guy, very sharp bank analyst, and I think it's important to tune in and take seriously when smart people are saying something that's opposite of your thesis. I happen to think that I happen to see Moynihan's what he's doing as a positive for the bank. He is shrinking certain parts of the operations, but I think those are parts of the operations that are in need of shrinking. And meanwhile, setting the bank up for growing in areas that that will be more profitable and better will help the bank thrive over the long term. And frankly, just setting it up for a better interest rate environment. So I like Moynihan. I think he's a fine banker. I don't think you want anybody that's flashy in there.
Right. I've been critical of some of the things Moynihan has done, and Mayo points out scaling back the mortgage banking business right before the refi boom. He's saying that's potentially cost the bank $6 billion in revenue. So I've been critical of that as well, but I don't necessarily agree with him saying, well, they're shrinking the bank, but then touting how diverse it is. I disagree with that because they're shrinking things, like you said, that are pretty non-core. Selling the stake in China Construction Bank, that's shrinking the bank, but that's not core to the operation. So I happen to agree with some of the stuff they're doing over there. So kind of on the fence, somewhat agreeing with Mayo, but I think I'm more so with you in agreeing that it's a little off base.
All right, second tweet. We've got Reinsurance Master. The Twitter handle is @ReinsuranceM. Says, Earn hits the cover off the ball. Glad I loaded up a few days ago.
And I'm going to guess that you don't know what Earn is, or do you?
I actually don't know what Earn is.
All right, this is,
let me know.
Full disclosure, I'm not an Earn
expert.
We should say that we're not talking about earns here. This is WARN. That's the ticker symbol for Ellington Residential Mortgage REIT. So this is a mortgage REIT, and it hasn't been on my radar because it just came public and IPO'd in May. So It's very new. It's been crushed, not surprisingly. Not a great time to become a public company as a mortgage REIT in late May there. They reported earnings, higher net interest income. They were able to pick up some higher yielding assets this quarter and grew book value. So the stock is up 11% today. It was trading at a 25% discount to book. We talked about the other ones in the space that were trading at around 15 to 10%. So it's been crushed, reported some positive earnings here. Going to look into it more to see if it is kind of just a one-time thing, or maybe this management team has the mortgage REIT positioned well. So Earn, maybe one to put on your watch list and look into.
Without having looked at this closely, I would imagine that it's got a much smaller balance sheet than a lot of these competitors, right? And it just came public, so just raised some additional capital. So it's been putting more capital to work as a percentage of its balance sheet than everybody else at these higher rates, right?
Right.
So that would position itself, that would position the company well for right now, because we had the big bump in interest rates that hurt everybody, and then it's been smoother sailing for the quarter since then. But the longer term, the bigger picture is still that we're at rock bottom interest rates right now. So I wouldn't necessarily take that as they're brilliant.
Oh,
this
no,
is going to be the.
I
wasn't saying that you were saying.
Just saying it's one to put on your radar. There was a mortgage REIT that was up 11% in a day. I think that gets on a lot of people's radars.
That's the point that I'm making, is that 11% up in a day. Obviously, people are buying into that.
And it's still down since the IPO, so it's not like this is a world beater so far. So I thought that was an interesting one.
That is an interesting one.
All right, final tweet of the day. This is from Yahoo Finance. Is this the greatest tattoo in the history of finance? And this is from Business Insider. We have a picture of this tattoo. Yes, for those of you watching, that is Mike Milken.
For those of you listening, that is Mike Milken.
Yes, that is Mike Milken. There's a man with a tattoo. It kind of looks like a Wall Street Journal kind of
Yeah, it does, yeah. The little charcoal drawings.
Exactly, of Milken there. This guy's name is Billy Lee. He's a trader in Chicago, and he always said, he made a bet with friends that they said, you would never get a tattoo of Mike Milken on your arm. And he got one. Is this?
What did he get? What did he get in that?
I think he got like $100 from each. That seems way too low to get a man that has been, been outlawed from the securities industry.
Here is who is the obscure finance figure who you would consider getting tattooed on your arm?
Oh man, I have no idea. No, that's insane. Like I would. Way more than $100 here. For like $1 million, maybe I'd do it.
It would take you $1 million? What about Warren Buffett? Would you get Warren Buffett tattooed on your arm?
$500,000, I'd do it.
Really?
That's ridiculous.
I would get Warren Buffett tattooed on my arm for substantially less.
$50?
No, not $50. It would take a legitimate amount of money, but not $500,000.
It's a little crazy, but this guy really likes him, so I guess you gotta tip your hat to him. Really, if you like something, this guy went after it.
I guess you do. Well, that's our show for today. You can tweet us at TMF Financials. That's at TMF Financials. Send us your comments, questions. Our email address is WTMI@fool.com. I am Matt Copenheffer. This here is David Hanson, and we'll see you tomorrow.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.